Welcome everyone to our webinar today, New 2021 Payroll and HR Rules, What You Need to Know. And there is a lot to know, so we're really glad that you're here with us. We'll be reviewing some of the important payroll, tax, and HR updates for the year ahead. And as we go along, please feel free, ask any questions you have by adding them to the questions section of your GoToWebinar panel. We do have time allotted at the end to get to any questions that you may have. And feel free, test this section out. Let us know where you're dialing in from today, or just type in a quick hi. We are calling in from a very rainy Atlanta, Georgia. And also be sure to check out our handout section in GoToWebinar. We'll be emailing this to you after the presentation along with a detailed state-by-state guide. And please note all attendees are in listen-only mode and will remain muted throughout this webinar.
And just to introduce ourselves, my name is Jessica Miles. I'm a product manager here at OnPay. Part of what I do is make sure that all of these updates are implemented into our system to make sure our compliance is really easy for you guys. I have 10 years of experience. I recognize some people out there, so hey to everybody I've talked to before. And I'm certified by the payroll professional, or as a payroll professional from the American Payroll Association.
And I'm Cara Rajapakse. I'm a member of the partner development team at OnPay. I am also certified through the American Payroll Association, and I work primarily with our accountant and bookkeeping partners to make sure they have everything they need to serve their clients.
So today we're going to go over a couple of different things. First, we're going to talk about what's on everybody's mind, I'm sure, COVID relief and the PPP loans, the ERC, FFCRA, all the acronyms. We know there is pending legislation. We are not going to talk about any pending legislation today. We're just going to talk about what's already passed and what's been updated kind of in January and December as we saw those things update. And then we're going to talk about things that change every year. So year over year, we're going to talk about cost of living adjustments to things like health plans, retirement plans, Social Security wage-based limits, mileage reimbursement. We'll also talk about state-specific requirements like paid family medical leave, workers' comp, and workplace trainings.
And without further ado, let's dive into new legislation that passed late last year. As 2020 came to an end, Congress passed the Consolidated Appropriations Act 2021. Sorry, there's no catchy acronym I could say in its place here. This new legislation, it expands the CARES Act, also known as the Coronavirus Aid, Relief, and Economic Security Act, to help small business owners in several ways. Those ways include a second draw of forgivable Paycheck Protection Program or PPP loans, more favorable tax treatment of expenses related to PPP loans, expanded use of the Employee Retention Credit or ERC, and an extension of the FFCRA paid sick leave credit. So Jess, can you kick us off with some details?
Yeah, so first, the window for PPP loan applications originally closed on August 8th, 2020, but the new legislation makes it possible for businesses to receive a new loan or a second loan until March 31st, 2021. If this is your first PPP loan, qualified businesses can apply for a loan up to $10 million, and that's based on your average payroll expenses. To be eligible for the new round of PPP loans, your company must be one of the following business types that we have here listed at the bottom left of your screen.
So take a look at those, and if this is your second round, you are eligible for an additional loan of up to $2 million if you meet the following conditions. You've used the full amount of your first PPP loan, you have 300 or fewer employees, and you saw a 25% drop in revenue during any quarter of 2020 compared to the same quarter in 2019.
The covered period from when funds from a PPP loan must be spent is the borrower's choice of either 8 weeks or 24 weeks from the date of distribution of the loan. The new legislation extends the final date which the original loans must be used by, so those round one of PPPs. Originally, you had to spend them by the end of 2020. Now you have through March 31st, if you hadn't spent it already, of 2021 to make that count. So any new PPP loans, so kind of some people are calling this PPP2 or PPP round 2, will have also 8 or 24 weeks as a covered period option. We want to mention that if you applied for forgiveness of your PPP loan last year, there was an option called the alternative alternative payroll covered period. With the Consolidated Appropriations Act, that's actually been eliminated for 2021. So you would have to use the covered period of either 8 weeks or 24 weeks from the distribution date of your loan.
Definitely good to note. And also something to note is that expenses that are eligible for forgiveness have also been expanded. So to have your PPP loan forgiven, you must spend at least 60% of your loan on payroll expenses, and the other 40% can come or count towards specified non-payroll expenses. So think items like rent, mortgage, utilities. Now, under this new legislation, the list of eligible non-payroll expenses has been expanded. That includes expenses related to software, cloud computing, human resources, and accounting needs. And there's a bunch of others. So if you take a look at the bottom of the slide, we have some listed out. I do want to emphasize again, though, that in the slide deck that we're providing and that you'll also find in handouts, we do have a resources section where we have an article that outlines, covered non-payroll expenses in much more detail.
The new legislation also simplifies the PPP application and forgiveness process. So let's talk about the application process first. These changes are intended to streamline some of the required documents for submitting for that second loan or first loan. So of course, a new loan application form is now available. The SBA has released it. For second-time borrowers, the application process is going to be pretty similar to your first round of PPP loan. Now, if you use 2020 payroll expenses as your comparative period for your first PPP loan, and you're using the same lenders, you will not be required to resubstantiate your payroll expenses because you've already provided it. They've already substantiated it with the first round. So they'll use that same information if you'd like for the second round, just to make it a little easier on you. And then for loans of less than $150,000, the applicant is no longer required to submit documentation to establish a quarterly year-over-year revenue reduction of 25% or more.
And for both outstanding PPP loans and second draw PPP loans, I kind of like PPP round two. It sounds kind of catchy. PPP round two loans that are yet to be issued, businesses that borrow less than $150,000 can apply for forgiveness by filling out a simplified one-page certification form. That includes the loan amount, the number of employees retained, and the estimated total amount of the loan spent on payroll cost. Now, despite the simplified forgiveness process, we always recommend document. We really recommend still retaining employment records for at least 4 years. And honestly, generally, that's a good rule of thumb that we have for payroll documentation in general. And then in terms of the Employee Retention Tax Credit, or ERC, the new legislation expands eligibilities in 3 ways. The first is the required revenue loss has been reduced from 50% to 20%. Big jump there. And by required revenue loss, we mean a decline in the gross receipts for the first calendar quarter in 2020, for which gross receipts are less than 20% of gross receipts from the same calendar quarter in 2019. So just that comparison there. Second point is that businesses may now receive a PPP loan and take advantage of ERC. So that's a big one, and kind of related to that point. Point number 3, if a business did not claim ERC in 2020, they may now do so retroactively under the new legislation. However, something to keep in mind, there cannot be any overlap between payroll expenses that a company counts towards a PPP loan and the ERC. No double dipping, folks.
Yeah, so now more than ever, companies are eligible because of these changes with ERC. So let's take a closer look at it. The recent legislation now allows eligible employers to claim the tax credit quarterly through June 30th of 2021. Eligible employers can claim 70% of wages paid in the quarter. The maximum amount of wages that will be considered for the ERC credit is $10,000 per quarter. So this means employers can receive up to $7,000 per full-time employee per quarter for ERC credits in 2020, and that's $14,000 so far in 2021. And that's a huge increase compared to last year. And it was only $5,000 for the entire calendar year for 2020.
Yeah, that is definitely a big change. And the new legislation, as we mentioned previously, it also expands eligibility requirements. It allows some businesses that receive PPP loans to retroactively claim ERC from 2020. And to be eligible for these tax credits, you must meet the following criteria. Business operations are partially or fully suspended due to a COVID-19 shutdown order, or like we also mentioned earlier, gross receipts declined by more than 20% when compared to the same quarter in 2019. This credit will continue until the gross receipt decline is less than 20%. And again, we are sending a copy of this to everyone. I know we're throwing a lot of numbers at you, so you will have it in writing.
And as you may be aware, the Families First Corona Response Act, or FFCRA, was originally signed into law in April 2020. It was intended to help small businesses and their employees during the COVID-19 outbreak by creating paid leave if the employee gets COVID or needs to support or care for a family member affected by COVID or a school closure, something like that. This was updated through the Consolidated Appropriations Act, so we're just going to talk about those updates. The leave does create a credit, and it's an immediate dollar for dollar tax credit for those employers using it. So for 2021, the credit was extended through March 31st, so you can still offer it to employees through the 31st. However, now it's optional to offer it to employees. You no longer have to, or you're no longer required by law to offer the FFCRA paid leave. But if you do, you will still get the tax credit for it. One thing to keep in mind is that a business is only eligible to claim the tax credit fully for one employee once for the entire period of this. So it's not per year, it's for since April through May of this, or March of this year. So that means if the employee took the maximum amount of leave last year, so in 2020, they would not be eligible for the tax credit leave here in 2021. Also, I wanted to mention on voluntarily offering FFCRA, keep in mind if you do voluntarily offer it to employees, you have to offer it to all employees. You don't want to be seen as discriminatory if you let Susie take it, but not John take it. So keep in mind, if you do voluntarily offer it, it has to be across the entire company. So next, let's talk about some other federal changes that may impact you and your employees. These are generally cost of living adjustments that happen year over year. First, we'll talk about Social Security wage base. This did increase by $5,100. So the tax rate remains the same at 6.2%, but it's up to $142,800 now. As a reminder, both employees and employers are responsible for this tax.
And let's discuss retirement plans next. Truthfully, we're not really seeing many changes there. First, the maximum deferral limit for 401k, 403b, and 457 plans has remained unchanged for 2021. Employees can contribute up to $19,500 per year to any of these types of plans. And then the catch-up contribution limit for employees age 50 or older remains at $6,500 for a total of $26,000. So that's $6,500 plus the $19,500. This means if the employee turns 50 by the end of this year, December 31st, they can make contributions up to the catch-up limit throughout the year. The amount employees can contribute to both traditional and Roth IRA plans, that actually stays the same too for 2021, with a $1,000 catch-up limit if they are 50 or older.
So next, let's talk about a couple healthcare related items. We'll talk about FSAs and HSAs. So FSAs, and that stands for flexible spending accounts, they allow your employees to set aside a portion of their pre-tax wages to pay for qualified health expenses. These limits remain the same for 2021, so there was no change there. And then for HSAs, which is a health savings account, and these are savings accounts that are used in conjunction with a high deductible health insurance policy. And that allows employees, again, to save for tax. They save money tax-free against medical expenses. So these did increase slightly. So we saw the individual contribution limit increase to $3,600, while the family limit increased to $7,200. The HSA catch-up limit does stay the same at $1,000 per year, but one thing to keep in mind is that the catch-up for HSAs is actually 55 and older, which is a little different than what Cara was just talking about with retirement that's at 50 or older. So HSA, it's 5 extra years.
And to continue with this topic of health, let's discuss high deductible health plans. That is a health insurance plan with lower premiums and higher deductibles than a more traditional health plan. Please note that being covered by an HDHP is a requirement for offering a health savings account. And if you have employees on a high deductible health plan, there are some changes to the out-of-pocket expense maximums for individuals and families. You can see those listed on the screen here, but I'm also going to read them out loud. Individual out-of-pocket max, that increased to $7,000, while family out-of-pocket max increased to $14,000.
So the final update that we'll talk to about health plans is a change to QSEHRA or QSEHRA plans. These are qualified small employer health reimbursement arrangements, and it basically allows small businesses that don't offer health insurance to reimburse employees for medical expenses. Generally, a QSEHRA plan applies to businesses with 1 to 50 employees. The limits for employer contributions for both individual and family plans have increased. So the individual limit increased by $50, while the limit for the family plan increased by $100. And we do have that on here on the screen as well.
And there's definitely going to be a quiz on this later, so I hope you were paying attention. Just kidding. All right,
Numbers.
so many numbers. So now on to some updates for commuter benefits and mileage reimbursement. The standard mileage reimbursement amount decreases this year from 57.5 cents to 56 cents per business mile driven. And this is something we really often get questions about. Why did these amounts go down one year and up the next? The reason is because the mileage reimbursement rates, those are calculated by using an annual study of the fixed and variable cost of operating an automobile. So this includes factors like depreciation, insurance, repairs, tires, maintenance, gas, and oil. And in general, just a good way to, again, generally, if gas prices go up or down, the mileage reimbursement rate will follow. The monthly parking and transit allowance, we commonly call these commuter benefits, remains the same at $270 monthly. And this is something that can go towards parking deck fees, ride shares, transit passes for employees.
So now let's talk about some changes that happened at the state level. In 2021, we saw 28 states, 68 counties and cities, and Washington, D.C. increase their minimum hourly wage. It's a lot of those, so we're not going to go over those immediately, but we do have those in our guide, so you'll get that shortly here. More and more states are also adding paid family medical leave. Cara, you want to talk about that a little more?
Absolutely. So yes, more states are adding that paid family and medical leave laws. These laws are designed to make sure workers keep some of their wages when they have to take time off to recover from a serious illness, have a new child, care for a family member. And we are also seeing states adding requirements with different stipulations for eligibility involving the amount of time an employee gets paid leave and reasons for taking that leave. So you may be wondering, all right, Cara, well, how is this different from the 1993 Federal Family and Medical Leave Act? And you may have said FMLA, that's what it's more commonly referred to as. The FMLA requires employers to guarantee employees up to 12 weeks of unpaid leave for family or medical reasons. It also requires that employers offer returning employees comparable pay and benefits when they come back to work, if not the same job. But the FMLA doesn't apply to small businesses with fewer than 50 employees. So what we're seeing is that some states are now requiring employers to provide a paid option to offer some income while an employee is out on leave, extending paid leave to smaller businesses essentially. Now, it can vary from state to state, but most paid family leave is paid through taxes collected from the employee, employer, or both, and is typically collected and remitted to the state by the employer. And we're seeing a lot of these collected as a payroll tax, actually. And to be a little bit more state specific, so be on the lookout, listen for your state. California, New York, New Jersey, Massachusetts, and Rhode Island were some of the first states to have paid family and medical leave, also referred to as paid family leave, PFL, PFML, payroll, we love our acronyms. And in 2021, we are seeing a new requirement for the state of Connecticut. So this program in Connecticut, it is fully funded by employee payroll contributions. It covers employers with one or more employees, and there are certain wage and employment stipulations for an employee to take advantage of the benefits offered under this program. The payroll deduction itself, it is capped at 0.5%. And the reason I stressed employee earlier is because there is no employer match under their program. So Connecticut employers out there or accountants and bookkeepers helping clients in Connecticut, just know if that business is eligible for an exemption to this program, they still need to register with the state agency for this.
Yeah. So next, let's talk about workers' compensation requirements. Workers' comp protects both the employees and employers when somebody gets sick or injured on the job. So right now, Texas is the only state where workers' comp is voluntary, although it's still really highly recommended, even in Texas. Currently, 4 states require employers to get coverage through the state-funded plan, through the state-owned program. These states are North Dakota, Ohio, Washington, and Wyoming. It's definitely important that you check that you're meeting the requirements in your state, that all of that's covered. If you've got a certain number of employees, if you increased your employees and didn't have to have it before, now you might. So just to keep that in mind, it's always a good thing to check at the beginning of the year. Because there could always be really hefty fines if you're not compliant. So want to make sure we're compliant there. Next and last but not least, we'll talk about harassment training requirements. 40 states either require or highly recommend sexual harassment training for all or some employers. In many cases, the state dictates what kind of training it should be. So for instance, in New York, all employers are required to provide employees with an annual interactive sexual harassment training. In 2021, we're seeing updates to states like California and Connecticut. In California, employers with 5 or more employees must train all employees and supervisors within 6 months of their start date and retrain them every 2 years. This even extends to temporary or seasonal employees who must be trained within 30 calendar days of their hire date or within 100 working hours, whichever comes first for that employee. Connecticut, on the other hand, is requiring employers of all size to provide at least 2 hours of sexual harassment training to supervisors. Employers with at least 3 or more employees must also provide existing employees with at least 2 hours of training within 6 months of being hired. So even if your state isn't updating their laws right now, this could change in the near future. So it's great to be proactive on this issue. It's not only a best practice, but a way to build a strong culture.
Absolutely. And on this slide, there's a bunch of resources we put together for you with all of these updates outlined. We hope this webinar has answered most of your questions about the payroll, HR, and tax updates for 2021. I know that there's a bunch of changes that this can feel overwhelming, so please feel free, add your questions in the chat. If the questions are a little too specific for us to be able to answer at this time, or if we can't get to your question, we will make sure to follow up with you by email if we don't answer it live. And coming your way tomorrow will be our comprehensive payroll and HR changes handbook that you can use for your reference or share with your clients if you're an accountant or a bookkeeper joining us today. So speaking of, let's see if we can take any questions. If you do have to go, though, I do want to say, hey, thanks for joining us for this webinar. We hope you have a great Friday Eve. We're almost there, folks. But I'm going to take a look at the questions, see what we have here. So let's take a look here. So question from Candace, how is OnPay handling ERC for 2021 and or for amending 941 for fourth quarter 2020? So Candace, and just feel free to step in just to make sure I give the complete answer, but you would need, for 2021, you would want to let our support team know when that ERC needs to start for you or your client. And we would be able to enable it on the back end. As far as I'm aware, we are not processing any amendments for retroactive ERC credits taken in the year 2020.
So Cara, I will add to that. We will do a 941 amendment if you know the exact amounts per quarter that you need us to do. And the reason for that is because we can't do we can't assume we know when your PPP loan might have been. That's the reason a lot of people are kind of going back to 2020. But if you know the amount per employee per quarter, can send us all that information. Our operations team will do that. You just need to send an email to hello@onpay. So.
Nice. All right. Well, there you go, Candace. We can help out with that. All right. So, question from Salim, and I hope I'm pronouncing your name correctly. So, Salim asks, if the company does not have legal obligation to provide FMLA since it does not meet the requirements, do they have to provide FFCRA credit for the 2020 in 2021? So, and this again may be something Jess can expand on because she handles compliance, but the FFCRA credit for this tax year 2021 that goes until March 31st, 2021, that is not a mandatory thing that you as the employer have to offer the employees.
Yeah, so to expand on that, Cara, 2021, you're not required to offer it. In 2020, you were required to allow employees to take it if they requested it. So if you need to amend any wages or anything like that, you can certainly reach out to our operations team. If you had to back pay something in 2020, they would have to do an amendment to the W-2 and the 941 to account for that. But yes, FFCRA did have to be legally, it was required to offer it to employees, but this year for 2020, it is no longer legally obligated, and that was regardless of your FMLA status.
Perfect. And then question from Maria, how do we determine if an employer needs to submit a POA? Maria in San Diego, nice to have you here with us, Maria. So on our help center, and I'm going to include this link for everyone, we actually have a state tax map. And if you click on that applicable state, we will let you know what third-party access we need. And we would also include POAs if those are required. So it's a clickable map, especially if you have clients across multiple states, this can help. So I'm going to add that to the chat section for everyone right now. And let me make sure I'm sending it to everyone, not just myself here. Perfect. So take a look in that chat. That should help you out, Maria. And then to your follow-up question, how do I get the handbook? I was about 4 minutes late. No worries. We are sending out a follow-up email tomorrow with links galore and the handout, but you also can take a look in the handout section of GoToWebinar. All right, so let's take a look here. Question from Deborah. Just this question will be for you. The retirement plans, how much can an employer contribute?
Yeah, so generally it is going to be a matching percentage, and then there's an overall percentage that employers can contribute up to, or a total comp that you can get up to. I can send you more information from the IRS, Deborah, on that to make it make sense, because it also applies across multiple types of plans. So it's a complex answer, so I won't go too detailed there, but if you had a simple IRA and then also had like a 401k, those limits apply for employers across all types of plans and retirement. So great question. Happy to send additional information.
Perfect. And then, so Brandon, I see that you asked a question about the FFCRA extension. You gave us business-specific details and employee-specific details. So we will follow up with you directly just because that's such a specific situation. The information that we're going to provide, it's going to be generalized though, so just please don't take it as formal, tax or professional advice. We always recommend consulting with a tax professional, but we will follow up with you directly by email on that. All right, let me take a look here. So I have 2 questions regarding mileage. Question from Christia. Regarding the mileage, if we offer mileage reimbursement, do we have to offer the 56 cents or can we choose our own amount?
That is a great question. I love that question. You can offer whatever you'd like for mileage reimbursement. What the rate, the 56 cents is a standard business rate. So basically that IRS sets that as that's the rate you can legally exclude per mile from their income tax. Now, if you want to pay $1 per mile, then anything over 56 cents is taxable to the employee. If you want to pay less, that's completely up to you. But a lot of businesses, what they do, just to keep it simple, is they go up to the IRS max, because the IRS does all that fancy math to figure out what we should offer mileage at.
There you go. Leave it to the IRS to do the math for us. And then kind of related to that, Jordan asked, do you recommend that you inform employees of the mileage reimbursements?
That is completely up to your company policy. If the employee is driving business miles on their car, then it is good practice to offer that reimbursement, especially if that's standardly. Like if you have an employee who, you know, generally would work in Atlanta, but they have to go to Orlando every week or every 2 weeks or something like that for work purposes, and they drove their own car, then you would definitely want to reimburse them. If you're not, it's not something that employees really typically ask for. It's more your company policy. But if you're requiring them to do it, generally it's a good practice to reimburse for it.
Perfect. Thanks so much, Jess. And then I have a question for Maria. When is the deadline for this? Maria, I'm not sure if you're referring to submitting the power of attorney or POAs for like those state-specific POAs. But if it's required for the state in order for us to file or remit any tax payments, then you would want to. Okay, perfect. Thank you for confirming. It is regarding the state POA. We would need those as soon as possible if it would hinder our ability to remit or file. Some states don't require that though. Some states are a little bit more straightforward, but just in case, and sometimes too, even if they don't require a POA, if there's a notice that your client receives, as an example, we may need the POA for the state agency to even talk to us or for us to file any amendments. So it can be very state dependent.
And then, Jordan, I do see that you followed up with us of the change. You're not required to alert them of it. It is public knowledge that these cost of living adjustments go out. It's generally a good courtesy though, since it did go down, to let your employees know that, hey, the IRS reduced the, excludable taxable mileage reimbursement. So just want to let you know that is going down 1.5 cents.
Perfect. And I'm going to pause for a beat, just give everyone the opportunity. If you have any questions to get in, I don't see any more for the moment, but let's just take a moment just in case someone's typing. I would feel really bad if I was like, okay, goodbye, everyone. But let's pause. I don't see any questions in the chat, though. All right, and so Brandon, again, we will follow up with you about your, specific question that you posed. And I appreciate everyone's time today. I always think questions make these sessions that much more interactive, and I hope you have a good rest of your week. Thank you.
Bye-bye.